Hi traders, welcome to the Markets in 3 with me, John, Senior Market Analyst here at Anzo Capital. I am here to give you the latest updates in FX markets, what are the big movers and where are the opportunities. So welcome to the show. Today we're going to be talking about the US CPI. How will inflation impact those gold prices? But before we get into that, let's dive into some of the notable headlines overnight, as well as some key interesting charts to look at. So what we're going to be looking at this morning is the latest data out of the RBA. So if I just bring up the economic calendar here, we can have a little look at what happened overnight. So what we saw was the RBA actually held interest rates overnight at, let me bring it up, 4.35%, right? So no changes to the RBA's decision there. It was highly likely that we were going to see that interest rate hold. It was forecast that we were going to see that interest rate hold. What we wanted to look for was if there was any key changes to the wording in the RBA press conference that followed. Now, if I go over and have a little look at the analysis of that, this is what happened. So the RBA kept the cash rate unchanged at 4.35% as expected, and the decision was unanimous. While it stated that inflation is still elevated and risks are skewed to the upside, but noted financial conditions appear to be somewhat restrictive, and it's trimmed its CPI forecasts. Okay. The RBA stated that the board will remain attentive to incoming data and the evolving asset of the outlook and risks when guiding its decisions. While it remains focused on preventing high inflation from becoming entrenched, and it will continue to do what it considers necessary to return inflation substantially to target, including raising the cash rate further if upside risks materialize. It stated that inflation remains too high and is not expected to return around the midpoint of the target range until late 2027, with upside risks to that projection. However, it also stated following 3 increases since the start of the year, financial conditions are now tighter than previously, and the economy appears to be slowing as expected. As well as stated that financial conditions in Australia appear somewhat restrictive and the economy is expected to return to balance in 2027, a little earlier than previously forecast. So what we're seeing from the RBA is the fact that they're still monitoring inflation pressures. They have said that inflation is likely to come lower, but it won't necessarily reach those targets until late 2027. So what happens if inflation rises in Australia? Well, they're going to be looking to potentially increase those interest rates because they're trying to bring it back down towards those target rates. If we have a look at what is going on in Australia right now and the key economic indicators for Australia, like the inflation rate, we can then have a little look at where they are sort of positioned as well. So if I just bring up Australia, we can see that inflation still remains high at 3.8%. But like stated by the RBA, we have seen a continuation of the downside move here. So we're at 4.6%. It's in the highs of March, and we're now down at 3.8%. So we are heading towards tighter financial conditions. So we are nearing that range where we expect the target rate to be between that 2 and 3%. Now, if we look at the reaction from the market when we had that data, if we have a little look at Aussie US dollar here, this is, if I go down to the hourly chart, we actually saw a little bit of downside to the price, right? So the market actually dropped lower, only by a few pips. It wasn't like a big move, a big surprise to the market. We only went down sort of 20 pips or so, which wasn't a huge move. The market was largely expecting them to hold interest rates at those conditions, and the language hasn't changed. So when we look at trying to trade these type of news events, there was no deviation from the mean, right? So because we expected that result because the market expected the tone from the RBA governor to remain the same. There's been little reaction in the FX market and for the Australian dollar in particular. One market that we've obviously been very interested in is the Australian versus the New Zealand dollar. And we can see that actually that market is starting to spike higher, right? If we look at the event, we had that downside initially from the news, but we've seen a continuation higher. The reason being is because we are starting to see data in New Zealand reflect a potential rate cut from the RBNZ. And if we look at the difference between Australia and New Zealand when it comes to the sort of economics around these things, if we take a look at New Zealand, we will see that, let me just put this by country, we can find New Zealand. We can see that New Zealand inflation rate has jumped higher to 4.1%. Okay, so they're looking a bit tricky there, but the problem they have is that their unemployment rate is at 5.6%. So their unemployment rate is climbing and their inflation rate is climbing as well. So they're going to have to try and do something either side of the dual mandate to try and help. So there is reports that there could be potential for the RBNZ to potentially change interest rates. If we take a look at this interest rate tracker here, and we can plot what's happening. So RBNZ, potential for a rate hike coming, but that is trying to tighten those financial conditions there. The RBA left on hold, and they're likely to remain on hold. But the interest rate differential is still very high. So the RBA interest rates are at 4.35%, and the RBNZ at 2.5%, because the RBNZ were one of those that cut interest rates very, very early, and now they're starting to pay for that. So Aussie Kiwi kind of finding support down towards these lows at the 1.1950 handle. Market is just finding a rejection here at the moment and is pushing a little bit to the upside. If we look at the 4-hour chart here, we can see that the market broke through and made new higher highs, almost formed sort of a inverse head and shoulders pattern down here towards this key level as well. So you can see left shoulder, head, right shoulder, market broke out of that. We've had one retest of the neckline, price started to move, but now we've had a recent rejection of the 1.1950 handle. If I just bring in a volume profile from the low, which was the head on the 3rd of August, up to the sort of right shoulder and the breakout, you can see we had sort of large volumes coming in around that kind of 1.1950 handle, and the market is started to move from there. So there could be some further upside for the Aussie Kiwi price. Aussie is a little bit stronger over there, but across other markets, we were looking at potential Aussie strength as well. So one of those would be the pound against the Australian dollar. This market has been pretty bearish for a while now. We are starting to kind of form a little bit of downside here again. We had the daily chart showing new lower highs being formed, so we need to see a little bit more of a breakout here. But look at the 4-hour chart, it looks like it's trying to create new higher highs, but that's not what we really ideally want to see when it comes to this trying to break lower. What I would like to see is price break back below this 1.9100 area, see if price can kind of get back below that, and then look for a move down towards 1.8950. Different picture over here on Euro Aussie. Euro Aussie is actually kind of still in that kind of downward trend scenario here. We've got the 1.65 handle as the key resistance above, and below of support we have 1.6050. The market here consolidating on the 4-hour, so a very different story compared to the pound. So again, I would like to see price break out of this range to the downside, break that low around 1.6340s, and then look to come back, retest it, and trade down towards the kind of current swing lows, the 27th of July lows, which were around about that spot 6260 area. If we break below that, then we do have that larger time frame support below. So looking for a little bit of a break and retest here on Euro Oz to see if we can see that continuation pattern to the downside. Okay, so let's go talk about gold. Gold is one of our ones to watch going into today. Gold prices have been very bullish, and the reason behind that is because we're seeing a lot of US dollar weakness in the market. We've seen US yields start to fall, which has caused a big spike up in the gold prices. And we talked about this a lot recently, that the data out of the US has not actually been that good, right? So if we go take a look at some of the key drivers behind the US, which is those key inflation figures as well as GDP as well as employment. So the payrolls on Friday, pretty bad, right? So we actually saw a big drop in those payrolls numbers. So employment as a sector is looking pretty bearish for the US dollar. If we look at the GDP growth rate as well, what we mentioned yesterday, that is also coming in lower. So pretty bad. Inflation has been falling, right? So the last inflation signal we had was 3.5%. So let's go take a look at what we're looking at today. So the pro-economic calendar is pointing out a few things, and I'm going to show you the minimum and the maximum because we want to look for the deviation from forecasts, right? So one thing we really need to keep our eye on is the core inflation rate month on month and the core inflation rate year on year. This is what the Fed is going to be looking at the most. The reason being is because this takes out the more volatile things like food, like oil, gas prices, right? Because you've got to think about this. The Fed can't control that. The Fed can't control what happens between the US and Iran. They can't control how expensive food costs are going to get, right? The only things that they can control is the sort of price stability and employment, right? So the reason how they control that is by using those interest rates. So what we saw last time when we had an inflation print, it came in lower, right? That came in lower. US dollar weakened because it basically put a dampener on those expectations that the Fed are going to hike interest rates. So we've had a really wild year. The start of the year there was two cuts priced in, ended up being no cuts coming in. Then it went to two potential hikes because of the US and Iran war, and now it's come all the way back down into potentially one rate hike. So this inflation print matters more than most because Fed Chair Walsh has stated that price stability is their main target, it's their main focus. So what we need to look for here is how do we deviate from the forecast? So the previous core inflation rate was 0%. Forecast is actually to rise to 0.2%, okay? And the minimum is 0% and the maximum is 0.3%. So what that means is if we get a core inflation print of 0% or lower, that will be bearish for the US dollar, okay? Because stock markets, or well, not stock markets, but bond markets will be pricing in less chance of a rate hike when we're already seeing inflation coming lower, okay? If we look at the core inflation rate year on year, that is forecast to come in at 2.5%, lower than the previous 2.6%. So the minimum on that side is 2.4%, maximum 2.8%. So again, if we're looking for that bearishness of the US dollar, then we need a print to come in around 2.4% or lower, okay? And if we do get that, then it means that the demand generally in the US economy is coming in a little bit lower, right? So if we get a shock above, though, again, what are the deviations above? If we see a 2.8% reading on core, then that is going to be very positive for the US dollar. And we're going to see the dollar strengthen. We'll probably see stocks come in a lot lower off the back of that. And we'll see gold come in a lot lower off the back of that. Okay. So gold is going to really depend on what happens here tomorrow, right? If we see a stronger core inflation print, a stronger inflation print, that's going to be bearish gold. If we see a lower inflation rate coming in, that's going to be very positive gold. Now, if we look at the gold price, the market is kind of pricing in the idea that we are going to see lower inflation. Why? Because we're seeing those employment figures coming lower, right? And we can see that gold has traded down from the $4,050 level all the way up into the 4,400 area, right? Market on the 4-hour chart is making really nice higher highs and higher lows. What we have to be concerned is that this market is very, very bullish right now. And that means that sometimes the market can, move opposite to moves, even when it's really good data, because it's not in a position to read, where we see strong potential buying coming in, right? I always ask myself the question, if I want to be long this market, where do I want to be long? Where is my overall target for these moves, right? So we can see at the moment, price is kind of trading at previous resistance around that $4,400 area, right? So you can see that in the past, we had a low form here. Price broke down through, retested it on the other side, and continued to push to the downside. Price is now at this level of resistance, right? So we could expect some kind of pullback, maybe today, maybe even pre-CPI data, right? Now, if price does pull back, where's the likelihood it's going to pull back to? Well, we have this kind of support area just through here, around about $4,250. If I go to the 4-hour chart, you can see why I'm looking at this really. So if I just go to gold and we have a little look at what's known as the market profile tool, what I'm going to do is I'm going to go to that 4-hour chart. I'm going to zoom in a little bit and I'm going to grab my market profile tool. And I'm going to go from the swing low all the way up to the swing high, right? So basically, pretty much last week's price action plus, yesterday's price action. And we can see there's a few high volume areas, right? So like I said, that 4,250 zone, that has a strong volume area. If we look at the one just above that as well, we've got $4,333. That could be a good support area for price to continue to trade higher up into the next key resistance area. We also have very, very strong volume towards 4,050. But in order for price to get all the way back to this level now, we'd need a significant shift, right? So let's say we get a positive CPI print tomorrow and price is trading around about this $4,250 area. I like the idea of buying from that with moves up towards 4,450 targets, potentially 4,500. If, however, we see a stronger inflation print, then gold prices are more likely to continue to trade to the downside. So we'll likely see price break out of this kind of upward trend that we're in at the moment and potentially break down through that high volume level of the 4,250 and move all the way down back towards that 4,050. Because what we need to realize is that gold is a non-yielding asset. And if we go take a look at the US 2-year yields at the moment, they are still fairly elevated. We're breaking through a trend line resistance here. Now, we obviously, when we had the last, or we had the NFP print on Friday, very bearish US bonds, we saw bearish US dollars. But what we're seeing now is bond yields are starting to break back higher because the US and Iran are starting to increase in those escalations again. So we're starting to see oil prices move higher. This is having an impact on those yields, which is what's going to drive gold lower in the short term. If we see CPI print lower, then I expect bond yields to drop. That would be bullish for gold. If we see the inflation print coming hotter, that could be bullish bonds yields and very bearish for gold prices. So what we need to look at is how the US bond yields react. And what's quite interesting is obviously we have this kind of disconnection at the moment because bond yields are rising again and gold is also bullish. So we've got a bit of a disconnect here. If we look at the 10-year yield, that is jumped all the way back up to 4.75%. So it's pre sort of end of the month highs, right? So this is going to be something interesting to watch going forward, especially with the yields. Keep an eye on these in particular, because these will give you a big clue of what happens to gold prices going into this event tomorrow. So let's finish the day on the skill of the day. This is the part of the show where I show you a particular skill in the market. And today I'm going to talk about the value area of the market profile tool. Okay. So if you're unfamiliar with the market profile, this is an institutional tool that has been used for many, many years in the markets. It actually was first drawn up using sort of letters, right? And what traders would do is they would monitor the 30-minute price action. And if price moved a certain amount of ticks higher or a certain amount of ticks lower, they would give a little X score in that period of time. So what you'll see most of them look like is almost like, you know, it would be through this period here, it would be X, 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 and then it will go on to another letter. So it could be like D, 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 F, you know, F, and then it will kind of like produce these things over a period of time. So, you know, let's say it would be like a G, for instance, and the G would go all the way up to the top. So nowadays we get them as sort of bars, right? So very much easier to do, but you can actually map out your own personal market profile using graph paper and things like that. So it's very interesting to do. Now, if we look at this example here on Euro US dollar, what you can see on this market profile that I've drawn over the 7th of August is a few different things, right? You can see a bottom dotted line, which is the value area low, and you can see the top dotted line, which is the value area high. Now, what you can see in this area is we have these kind of like orange bars, right? Okay. And then on the outside of either side, we have gray bars. Okay. Now, what this is showing you is the orange bars between the value area high and the value area low is known as the value area, right? So this is the value area here. This basically means that 70% of all trading on this day happened within this zone. Okay, so when you're looking for high volume areas and you're trying to spot where the value is on a particular day, this is how traders do it. Now, there are a few key things to look at when it comes to the value area on the market profile. The first thing is auction market theory, right? So auction market theory is the theory of how the market auctions between distributions, right, or areas of value. Okay, so what I like to look at are two different trading scenarios, right? If the market opens up and closes back within value, so if we look at Euro US dollar on the 10th, right, the market has pushed down back into the value area. It's then come back up, retested the value area high, and there's like failed to kind of make any significant ground above that value area high. In fact, we kind of had a false breakout of that area. Now we've closed back within the value area high. There is an 80% chance that we come back to the value area low. Okay. Now, if we look at how this is kind of mapping out, that's exactly what's happening. Price of Euro US dollar closed below the Friday value area high and is coming all the way back down and trending lower now towards the value area low. Okay, so that's quite significant. Let me take another market profile and we'll have a little look at yesterday's market profile, because this will be a good example of how you can look at this. If price breaks out of value area, okay, comes up, retests it, fails to auction back within the value area, that can be a rejection. And we can see some potential downside in that case, right? And that's exactly what's happening here with Euro dollar as well. The market has auctioned down, it's come back up, retested the value area low of yesterday and has rejected. So this is really important information that we can use in our trading. So let's say Euro US dollar rallies back up. It reclaims yesterday's value area low. We know that statistically there's an 80% chance that price can go back to the other side of value. So we would be looking for longs back up into the value area high. Okay. However, we're not. We're outside of that value area at the moment. So the likelihood is that we're going to continue to trade outside of that point. Okay. So when you're looking at market profile, there are a few things that we have to note down. We have to note down the value area high, the value area low, the point of control, which is the most traded level within that area. We then also have to look at the value area in total, how price is reacting within that, where is it opened in that area. Okay, and this is very valuable when you use it on stock markets and things like that as well. So if we go take a little look at the S&P 500, for instance, okay, and we have a little look at that. Let me just open this up a little bit. Now, what traders can do is look at how price reacts to a previous session's value area or reacts to a previous day's value area. So you can see here on the chart on the S&P 500, I have the US session market profile of Friday. Okay, so that's the 7th of August. Now, what we can see, let me just actually take off the initial balance dashboard. But what you can see is I've printed out that value area here, right? And look what happened. The market, pre-market, right, opened up within value, traded outside of value, all of pre-market, okay? Now, what happened was it came all the way back down on the US Open, okay? At the US Open, it double bottomed at the value area high and broke back to the upside. So when you're looking for trading ideas, this could be a really good trading idea. One of my personal favorites is to wait for a breakout of value and price to come back to what's known as the point of control, the most traded area. So if I highlight the zone for the point of control and stretch that out to the right-hand side there, this could give us a second opportunity because price has come all the way back down to the previous session's point of control and rejected. Now, this is a 5-minute time frame that we're on, so you're going to be looking at very short-term trades here. But still, you know, those are key areas that you can look at for opportunities. So when I'm looking at today, I'm looking at, well, what is going on pre-market with price? We can have a little look at those key areas and key levels, right? So let me just take off this point of control. And what we'll do is we'll look at where that US session started yesterday, which was here. And we can pull over that US session market profile, okay, which was this. So when we're looking at this, we can say to ourselves, well, okay, price has opened within value. We've pretty much stayed within value, right? If I put a box over the value area high, value area low, okay, when we open in value and reject value area low, there's an 80% chance that we move to value area high. We had that. Price did arguably break out, but then it reclaimed value. It came back below the value area high. 80% chance that we move back to the value area low. Boom, it does it. So it looks like at the moment today we're going to be getting sort of a double distribution day. Sorry, not a double distribution day, but just a distribution day of a potential range day here ahead of the US CPI. So that's how you can use value to find opportunities in the market. Think of the value area as like a magnet, right? Price briefly kind of breaks above it or breaks back below it, but when it steps back into it, it can find value again. It can stay within that value area. Okay, so it's very important to think about that. So I'm going to leave it there, guys. Thank you for joining me today. I appreciate you turning up. If you did like this live stream and you found it interesting and you liked it and you learned something new, hit that subscribe button, that like button really helps us with the algorithm, and I appreciate it. So speak to you soon.